Well, earlier this year, I sat down with Bill, and I told Bill, I said, look, we've done a really good job with everyone's help in here of growing the commercial division of Capital Title. We really need to figure out how we can take advantage of what we've built and the platform we have in place and really take this to a national level. I would say over the last couple months or this year, we've had some good friends come to us and say, hey, we just closed this deal in Nashville or in Florida. Wish we could have used you guys. And, we're over here hitting our heads like, man, I guess we haven't done a good job really soliciting ourselves and letting everybody know, all of our clients and friends, that we actually close transactions in all 50 states across the United States. And so I talked to Bill about it, and we want to try to figure out how we were going to do that. And so Bill said, let me think about it. Talked to some of his friends, and Bill was able to get Ted Darby to come help us. Ted's been working with us for the last 5 months. He's done a great job. One of the first things Ted did was he really kind of dug into our operations and to better understand kind of how we're set up and what we're doing. And Ted came back and said, hey, look, I got some good news here. You already have a national platform in place. You're just not really soliciting it correctly. So one of the first things we did was we really tried to figure out what we could do as far as rebranding. And today I'm proud to announce that we are rebranding to Capital Title National Commercial Operations. So this really just explains more of what we have been doing and what we're going to be doing in the future, which is not only can we help you with your transactions here in the state of Texas, but we can help you with any transaction you have in any state across the United States. So we're really excited about it. Another thing that we've been working on that Ted's been helping us is our relaunching of our website. So you can go to Capital Title NCO, which is acronym for National Commercial Operations. So Capital Title NCO, and this will take you to our new website, which we have officially launched, and we're excited. I received an email the other day. Someone was asking me, hey, do you have a commercial rate calculator that we can use? And I said, yeah, just go to our website. So we've officially launched this, but what you'll see if you go through here is you'll see our national coverages. We have 185 offices across the United States. I don't know if y'all realize that, but we're a very large title company. We're actually the largest independently owned title company in the United States, and we're located here in North Texas, which is really cool. So you can come and see our website. You see all the offices we have and how we can help you all across the place. Another thing that I think is important that I want to make sure everyone understands is we have the ability of writing through many different underwriters. This is a list of all the underwriters that we use, and we actually have our own underwriter, FNTI. So if we have an issue or there's a certain project that one of the other main underwriters can't underwrite or don't want to underwrite or create a policy, we can go back to our own underwriter and get that done. So that gives us a lot of flexibility, which is really cool. But anyways, if you keep on going down on the website, you'll see our NCO offices here locally, and then down towards the bottom, our Houston office and our San Antonio office. And then what's really important that we've done a really good job of, and I'm proud of, if you keep on going down here, is these are all kind of our tools that we have in place now. So if you've got a question about, title premium rates, or you have questions about 1031 exchange, you can come to our website. You can hit these links, and it'll take you to those pages. So we officially launched this, and we're really proud of it, and we hope if you have any questions, you can always go to our website and get a lot of information, right? The second thing we've been working on that I'm really the most excited about is our real estate and title insurance national guide. We've spent a lot of time over the last 3 months putting this together, okay? So what's cool about this book is this will show you all the different fees, responsibilities, who pays for what for each state in the United States. So we've got a page for Alabama, Oklahoma, Texas, Alaska, you name it, right? And so what this will help you do is if you've got a transaction you're trying to do in a different state, you can go to this book, and it'll tell you all the fees that are associated with it. It's going to really help you out. It's something that your real estate attorney is going to need, right? And so we're going to be giving these out. These will be done in the next 30 days. Just let us know if you want one of these. We can give it to you, or we can give it to your attorney. But this is going to be a real asset for all of y'all. So if you're looking at selling something in a different state, you're going to be able to go to this, and you're going to have a better understanding what your upfront fees are going to be. and who's responsible for what. Very, very, very excited to get this out to everybody. It's going to be very helpful. So just like to announce those couple things. We're really excited about this rebranding, and we wouldn't be here if it wasn't for everyone's support. So we appreciate all of y'all very much. And so next I'm going to move on to getting the presentation going and actually introducing our panelists. So the first person I'd like to introduce is Jody Thornton. Jody's president of the JLL Capital Markets. And Jody began his real estate career in 1984 after graduating from the University of Texas at Austin with a business degree in accounting. Jody became a founding partner of HFF in 1992 and assumed the role of president in April of 2014. Today, Jody is president of JLL's Capital Markets and also sits on the Americas Executive Committee and co-leads the Capital Markets Industrial Group. Jody is responsible for the strategic leadership of more than 2,000 capital markets professionals across the United States, Canada, and Latin America. Thank you for being here, Jody. Appreciate it. Next, we have Brian Heflin. Brian is president of Plains Capital Bank. Brian has more than 36 years of experience in the banking and finance services industry. Brian has provided strategic direction and oversight of the Plains Capital Bank's Texas market and beyond. Brian currently serves on the Plains Capital Bank and Wealth Management Board and member of the Dallas Citizen Council, and is a young president organization member and is proud to be a Real Estate Council Foundation board member. Please welcome Brian. Thank you very much. Next is Ernie Gatewood. Ernie's Senior Director of Integra Realty Resources. Ernie began his appraisal career in 1980 at Crossan Danis, where he spent 10 years specializing in master plan communities. Ernie's 40-plus years of experience led to his appraisals being utilized in the funding of Legacy Business Park in Plano, Texas, as well as Stonebridge Ranch in McKinney, Texas. Ernie has experience in appraising industrial, multifamily, and investment-grade real estate property to provide opinions of value for purposes of mortgage lending, sales, finance, reporting, federal tax, capital lease testing, litigation support, etc. Please welcome Ernie. Thank you, Ernie. Last but not least is Kenneth Abuzzi. Kenneth received his undergrad degree from TCU and a business degree from McCombs Business School at the University of Texas at Austin. Prior to co-founding Stone Lake, Kenneth was a partner with the Cypress Real Estate Advisors, a private equity firm based in Austin. During his tenure at Cypress, Kenneth headed the firm's capital markets group and directed both acquisitions and dispositions of investments with a total capitalization of $700 million. Currently, Stone Lake has over 50 team members, owns over $4.2 billion of commercial real estate, and manages institutional capital through discretionary private equity investment relationships. Thank you for being here, Kenneth. All right. Need a little sip of water there. I've been talking a bunch. I just want to start off just really quick. Kenneth, I'll start with you. Could you maybe just kind of talk about some of the challenges you've dealt with this year and how you've kind of dealt with the market, and give just a little bit of a update on that, please?
Okay, great. Thank you all for having me, Jeff, Mr. Shattuck, Brian Fickey. Thank you all for including us. A lot of questions about, hey, where are we in the world and what's going on? And I think it's helpful to understand where we've come the last 3 years. We've never had a global pandemic. And all of a sudden, 3.5 years ago, we couldn't leave the house. We couldn't have a gathering like this. So the government reacted best they could, which was they injected trillions of dollars of liquidity into the system, and we're literally, helicopter money. And I'm sure you've never seen anything like that before. But the Fed was effectively lending to companies and to people. So all of which. That massive injection of liquidity makes its way to the banks, and so the banks were washing liquidities in deposits. That was one of the few times in my career where the banks weren't asking you to give them a deposit in which to make a loan. And so when you have massive liquidity and banks awash in deposits that led to a lot of lending, which led to incredible asset appreciation. And asset appreciation not just in real estate, but clearly in all assets, venture, buyout, the public markets, and what that has led to is inflation. And so now with inflation, the Fed went on what was unprecedented from a pace standpoint, rate hike, hiking 11 times in 15 months. That started in March of 22. So it feels like we've been in this for a long time, but we've been in this for 20 months. So in March of 22, the Fed starts hiking rates. They hiked by 525 basis points, 11 times. And now we're showing signs that we're stamping out inflation. But what also happened during that time and was the Fed is raising rates, they are withdrawing liquidity from the system. So this is kind of for every action, there's an opposite and equal reaction. And so the last 20 months was a period of contraction. We'll see as that leads the next 20 months. But we also had 3 major bank failures. And those 3 major bank failures have and Brian, you'll be able to talk about this more than I will, but have definitely set a tone with the banking community and the regulating community, and that's put banks fearful with respect to deposit flight, and so I think that's all helpful context as we kind of frame where we are, because you have banks that are nervous either to make a loan because they don't know where assets are going, or banks that are nervous to make a loan because they're not sure how it's going to be graded by the regulators. And you have capital that's trying to see how is the market going to reset from a value standpoint in this higher interest rate environment. And so we've been out fundraising. We just raised our 7th fund and had a closing about 30 days ago, and I just say that's and I don't want to go too deep, but I think that's a kind of a helpful context for the room, because everything that we're going to talk about is now we're in this deleveraging environment, and there's less loan capacity, and we're also resetting at higher interest rates where cap rates are, and therefore where values are. Is that a good pause, please?
Ernie, can you talk just a little bit about what you've seen this year with the appraisal industry? I mean, I know sales have been down a bunch, this year. Has that affected you? And can you just speak a little bit about that, and maybe talk just a little bit about what you specialize in specifically?
Sure. So transactions-wise, obviously are down. So the appraisal load work is down as well. The appraisal industry in general is much more competitive this year. And with a lot of these appraisal management companies, people are going with lower priced appraisals rather than getting a quality appraisal on their asset. So that's been a hindrance as well for our firm, I guess, in general, being a national firm. But I specialize in land, master plan communities, large developments, things that are being planned for 18, 24 months out. Those things are still going full speed. So my business personally has been very stable and very healthy.
Can you talk just a little bit about, what, to me it seems like, if we don't get a good appraisal on something, it can really affect the market in a lot of bad ways. I mean, a lot of banks, determine how much they're going to lend and all those things on an appraisal. So, I mean, you can really be like a front line on a lot of deals getting done. So can you talk just a little bit about, some of these other appraisal companies and the expense? Can you just talk a little bit about that and the importance of it?
Well, everybody knows that you don't like an appraisal if you don't get the number you want. But with that said,
Call that a bad appraisal.
exactly. So we really can't help that. But obviously with interest rates rising, cap rates are rising, it's going to affect values. We haven't seen any kind of depression in land values per se right now. We don't have any support for any decreases in value, but all of the improved property classes obviously are being hit with those. But and that goes back into saying with if you want a quality appraisal, if that may be called a good appraisal, but then you have to have somebody who knows what they're doing. And if you just go with the lowest price, you're not going to necessarily get the best appraisal.
One more question about that. So what, in your opinion, what makes a good appraisal? I mean, do you have to reach out to real estate guys that, have that experience?
So I've been there 40 years, but you have to talk to people. You have to know what's going on in the market. You have to gather good data. And a lot of appraisers if they're getting a cheap fee, they're not making much money, they're going to take shortcuts, and they're not going to do the job right and correctly and properly that they need to do to really find out what the true value is.
Thanks, Brian. Can you just, I know everybody's excited to hear from you with all the interest rates and everything going on this year, but what are some of the challenges you're dealing with? I mean,
Sure. I thought Kent did a really good job on giving a foundation on where we've come from. Obviously, the first of this year, we're heading into a rising interest rate environment. We did have the 3 bank failures. As you can see, during the right before they started raising rates, banks were flush with cash. It got to the point where you were almost having to say, okay, we can't prevent the money from coming in the bank. It was coming in so fast. And so you did see a lot of banks that had oversized cash positions and went long in the duration in the securities portfolio, chasing the yield, because the alternative was to keep it at the Fed earning 15 basis points. You saw that in SVB, got locked down in the securities. They had to sell, take a loss on those securities, and caused a panic. And not only did the 3 bank failures happen, but it also set the tone for the regulators as well. And I think, I don't think there's any regulators in this room. If you are, you can raise your hand for me. But
And we'll escort you out.
right, right. And so they probably have more of a not on my watch attitude right now. And even if you look in the state of Texas, most of those banks, the 3 that failed, were all based out of California. I don't know if that's just a coincidence or not, but and Washington, Congress, and you have some congressmen wanting to increase regulation, and it's not really the regulation that we need more of. It's for them to enforce the regulation that we have. And so I think some of the stuff that happened out in the 3 bank failures weren't enforced like they are that we see in our markets here. But fast forward, we have rate increases. A lot of banks that had, for the most part, free money to loan to are now having to pay up for those deposits to keep them, as the Fed's trying to suck the liquidity out of the marketplace to lower inflation. You're seeing the effects of rising interest rates, both in deposits and both in loans. Most banks, you've seen a compression in the margin, their net interest margin. So from a profitability standpoint, those margins have been squeezed over the last 12, 18 months. You'll see the banks that weren't maybe loaned all the way up, that were fine with letting some liquidity out versus paying up for money just to put it over in the Federal Reserve. But you're still putting pressure on liquidity in the system with the Fed raising rates. We do think, hope that rates may take a pause. This morning, looking at the futures, it looked like there's a 97% chance that December's going to have a pause as of today. But, that's just a guess on anybody's part. Things can happen. There's a lot of effects that I'm sure we're going to be talking about a little bit later. But overall, the economy here in Texas is great. We're the 8th largest economy in the world. There's job growth. We're one of the top, if not the top, job growth states, depending on which month you look at. And so there's a lot of, from a business and climate environment, the CEOs have in America surveyed has Texas the #1 best place to do business. So there's a lot of positives for Texas. And so I do think that we are in the best spot in not only the nation, but the world to do business at this point in time.
Great. Jody, can you just speak a little bit about the capital markets and the changes you've seen this year in that segment?
Sure. First off, I've been in the business way too long, and the one thing that I just want to emphasize with everybody is if you look up real estate in the dictionary, it says it's a long-term asset. And everybody always wants to get caught up in judging real estate on a 12-month, 18-month, 24-month period. I mean, it's not the stock market. It's a long-term asset. And if you track every rate hike, that we've ever been through, the average time of the hike and the plateau has been 32 months. And I think Kenneth said we've been in this one about 18 months, right? And so I think if you asked kind of leadership at JLL, I think what we'd tell you was we think that 2024, it may be the end of 2024, we're going to start seeing transaction activity pick up. The 10-year Treasury is down now to about 4.3. We are seeing a lot more requests from a lot of our customers seeking construction permanent loans from our life insurance companies, which we haven't seen that much in a long time, just because those loans are priced off the 10-year Treasury and they're not priced over SOFR. And the only good news I can give you on SOFR, because it's a big topic of frustration for me, is that SOFR and LIBOR always track inflation. And if you look back at the last 6 to 8 months, inflation's been coming down, and those rates always track inflation. So I'm hoping in the not too distant future, we're going to see a drop in where LIBOR has been. And the other two things that I would tell you is that compared to when I first got in the business, I do not think we have a supply issue. In the 80s, we had a massive supply issue. We don't. Everybody's whining about industrial reaching a 5% vacancy, and I'm going, really, we're crying about a 5% vacancy in industrial? And I would tell you the other thing is over every year that I've been in the business, we have more equity in the business than we have ever had, which allows you to stand firm when we go through a time like this. And I'd tell you, we do more JV equity business than anybody in the business by 5-fold. And the average deal we do has 35 to 40% equity in the deal, which I think allows you to stay invested. If we go through cycles like this, you can weather through them. You cannot worry about it. I do think that we're seeing we had such an increase in rent growth in industrial. I think we're seeing that tail off a little bit, obviously, and that had to come. And I also, when you're selling industrial buildings at a cap rate that has a 2 handle, something's coming. That just can't go on, and it was free money. So to me, I'm very optimistic. There's a lot of dry powder in the business. Everybody's just trying to wait to figure out the math. Obviously, the return on cost metrics for getting a development deal has, across all product types, has definitely changed. But I'm pretty optimistic about where the business is going. And again, if you talk, Bloomberg's done 10 studies. All those banks, investment banks, accounting firms, everybody, they really do think that within the next 12 to 15 months, the 10-year Treasury is going to settle out somewhere between 3.5 and 4, and I think that'll be just fine. So, and right now, even we're doing permanent loans on deals with the Treasury at 430 at 150 over, so we're sub 6 on some permanent loans, which we can make that math work. And even if it's negative leverage for a little while, it's not going to be negative leverage for long. So.
Very interesting. Kenneth, you want to talk just a little bit about, maybe touch on, how interest rates have affected you, what, probably caused you to be a little nimble and get creative and just maybe also talk about, what your expectations are for 2024 and kind of where y'all are headed next?
From a how interest rates have impacted us, we've historically maybe been 60% industrial. Stone Lake's been about 60% industrial, about 30% multifamily, about 10% office. The industrial and the office was always new construction, and the industrial's both new construction and acquisition. For the last 2 years, the only thing that has been approved by our investment committee, which I sit on, has been industrial. So we've really pivoted in this higher interest rate environment away from multi into industrial, primarily driven by what Jody was talking about, rent growth. The rent growth in industrial has been exceptional. You do get contractual annual rent bumps there as well. But triple net leases, the operating expense side in multi has been tough. Insurance costs are up, property taxes are up, and in your just pure operating expenses, the janitor or the front desk person costs more today than they did 3 years ago. And so, all of that coupled with a higher interest rate environment has made, in our view, multi more challenged. And so we've pivoted. The last 2 years, we've only invested in industrial. I started with just kind of, hey, where have we come from? And I felt like maybe that was some of that's negative. I do want to talk about things that we think are positive. Texas in particular, I was at an event in New York the last couple of days that JP Morgan hosted, and these are Northeasterners, and I mean, they couldn't sing Texas's praises. I mean, it sounded like, one of us. They couldn't just sing Texas's praises more and more. I would just say kind of everybody always has been pro business, but now I don't think Texas is viewed as a flyover state. Capital wants to be here. People are moving here. And so when you look forward the next 24 months, I think we do likely go into a recession at some point next year. That just is a further flight of population out of California, out of New York, out of the Midwest, high tax environments to low tax environment. And that population growth creates demand for space. Additionally, if you want to look for the glass half full, as the banks have pulled back, no one's really gotten a construction loan to speak of in the last 12 months. And so supply and demand are going to have, and across all property types, but I'm specifically talking about industrial and multifamily, are going to have a chance to really get into not just imbalance, because they're pretty well imbalanced, but to a point where demand is outstripping supply, and that's going to lead to rising rents, and that leads to rising property values. And so, we're active, and in the I guess two other things as positives to talk about. One is, what's going on in the flight of manufacturing out of China specifically, but really Asia as a whole. CEOs woke up, in March of 2020 and go, why in the world are we manufacturing on the other side of the world? And now I can't even go over there, and my supply chain is too fragmented and too far, and so they're bringing manufacturing back closer to home. And both because of that, and then geopolitical tension with China, and China didn't have enough labor, and so all that really is leading to an industrial resurgence and a manufacturing resurgence in the United States, in Mexico, which the southern United States will benefit from. And so, I think there's a lot of tailwinds associated with that, and that's property, plant, and equipment that doesn't move quickly, but when it does, it's there for 20 years. So those are long-term decisions that I think everybody, particularly in Dallas and in this room, will benefit from. And then finally, you know, on the buy side, listen, we're buying at higher cap rates today. It's been hard to buy the last 2 or 3 years, and you know, in a higher interest rate environment, you can go get to something that maybe not day one, but you feel very confident in year 3 that you're in the sevens and positive leverage over a 6% interest rate, and so I do think there's a lot of positives. The one other kind of looming unknown is we have an election next year, and you know I think we've got two of the most doesn't matter if you're a Republican or Democrat. I don't think anybody's really excited about those two candidates, and so you know how that unfolds is an unknown. But I do think that at some point, as the banks have pulled back, the economy slows. That's what the Fed's trying to do, and that hopefully leads to rate cuts, which would be welcome for everybody in this room.
Ernie, you have anything you want to add on that? I mean, do you what variables do you think we'll see next year that are going to affect valuation on property? I mean, I know y'all do a lot of different things, but you know, if someone's going to go fight their property taxes or get an appraisal, I mean, what variables do you see that are going to affect your industry next year? Industry.
Well, obviously, we need more market activity to increase the loan activity. What I'm seeing personally is, for my clients, is a lot of non-regulated lending. So a lot of stuff I do is bond sales. They're getting financing through bond sales. Do a lot of public improvement districts as well that are sold on Wall Street. So that's an alternative source of funding. But for the local, I guess, economy base, really, it's going to depend on what the Fed does and how they lower those rates and how fast they lower those rates.
Brian, I think everyone's pretty excited to hear from you on this.
Well, I mean, I think Jody mentioned about 36 months on the Fed on the peak. On average, for the 20th century, it's 9 months from the last rate hike to the first rate cut. If you look out in 2024, as Kenneth said, we have an election year. Usually the Fed tries to steer clear of the election, so you got a lot of things at work in 2024. If you look out can the Fed stick the landing? That's the question. And I think we're going to be in better shape here in Texas than we will be in the rest of the nation. It is coming down. I think the PCE core came out this morning, and it showed right at 3.5% year over year, which is a measure that the Fed, who's data-driven, looks at. I think that's positive. So, from an interest rate standpoint, we're hopeful that they're finished. Crystal ball, it's kind of hard to predict when. We do think that rates, if you talk to our group, we feel that rates will start coming down next year. Some are predicting, you're seeing as much as anywhere from 100 to 125 basis points. Seems like a lot right now, but it could happen. We just don't know. We're just going to have to continue to watch the data that the Fed watches.
Judy, what do you think about the capital markets next year? What are they looking for? Are they looking for interest rates to come down, or what are the main factors you're going to see next year?
I think, again, there's a big difference between floating rate debt and fixed rate debt, right? And, if you look at the balance of lenders this year, I'd say it's been pretty even between, some of you were talking about multifamily, so the agencies, the banks, the debt funds, and the life companies. The lending source that we've always had that's been pretty much sitting on the sideline is CMBS, and I think it's just it's going to be a matter of time. They're still just trying to, I think, kind of figure out the math, and as I said, there is a ton of dry powder. sitting on the sidelines that's just waiting. I can't tell you how many sovereign wealth funds, pension plans, advisors that we talk to that are saying we're just waiting for the first quarter, we're waiting for the second quarter, the third quarter to be able to go and do something. Because if you look at, again, my career, having a 430 treasury, I mean, when I got in the business, interest rates were over 10%. Now, I understand the denominator is much lower now, so if it moves just a little bit on a percentage basis, it's a lot greater. But, I mean, we just sold an industrial building here in Dallas, just sold it last month, 440 cap rate going in. But the deal had a WALT of, I want to say, like 3+ years. And in 3+ years, they were going to be over 6. And when they rolled the rents. And so I really just think, this is just Jody talking, but I think the business got so crazy and so easy, we are back to a point where the business is going to be, it's harder. And you got to really work through deals, the right deals, good deals to get them done. And I think it's something with where the business was back in 21 and early 22. I think we needed it for all the reasons that these guys have been talking about. For inflation, everything else, it was kind of nuts, and it needed to kind of come back to center. And I think that's going to happen. It may not happen in a great way in 24, but I think by the time we get to 25, we're going to see things really coming around. And to Boosie's point, I've never seen our guys heading to Laredo and El Paso and San Antonio more than they have in the last 6 to 8 months. And Mexico is really on fire, and we knew the onshoring was coming. We've done more transactions in like Savannah and Charleston than I ever thought I would hear us do, just because those port towns are really getting going because of that. The only thing out there that I see that it doesn't make me nervous, but I really do think it's going to take a longer period of time to work through it, is the office market. I think, the back to the office, I do think with the economy going where it's going, the employer is going to start to have a lot more of a say. And if it were me, I'd say, get your butt back to the office or you don't have a job. And I think you're going to start seeing a lot more of that. But, there's definitely going to be some of the older office that we've all seen. I think that's going to be, it's going to be bought, it's going to be scraped and turned into an industrial building, or it's going to be recommitted to something else. I think long-term office is going to be just fine. I think that's going to take a little longer to work through. And I will say this, I've seen all the lenders that we work with that took a very hard stance on some of these renewals that were coming up on office buildings, and they've totally pivoted. Much more willing to work with the owner to extend the loan. Yes, I want a $10 million pay down. Oh, wait, sorry. Now just take 2. And, we can extend it for, 3 or 4 years. And I think that really needed to happen. And I think the other thing that happened too was, I think for a long time, having an appraiser sitting here with me, he probably didn't do this, but we did. I don't think we really underwrote office buildings when you consider the full effect of TIs and commissions to get to a real net operating income. I think we'd use a reserve number or something like that. And TIs and commissions on office deals are ridiculous. They're $100, sometimes, and all this. And I think where people are going to now, they're really underwriting those office buildings mathematically and correctly to get to a new NOI number that's going to kind of affect office, which is why, again, I think it's going to take a little longer time to work through some of those office buildings. All the other, I feel great about hotels, retail, industrial, multifamily, obviously all the specialty stuff, data centers, there's a lot of talk about recently. You do hear the power issue come up a lot on the data center stuff, but again, I just think we got to keep our head down and plow through it. But for a longer term perspective, I'm still very bullish on the industry.
Great. Brian, I'm going to ask you a quick question just about the banking industry in general. I know we with those 3 banks we had issues with earlier this year, put a lot of pressure on the banking industry, and it caused people to move a lot of money around. And, banks, especially regional banks, need those deposits. And so that's put a lot of pressure on these regional banks. And, I think one thing Bill and I talk about all the time is we really need these regional banks, because they're the ones that are lending this money on a lot of the commercial stuff we've got going on. So regional banks are really, a foundation of our business in a lot of ways. And so I just want to ask you really quick, what are you kind of seeing with, some of these loans that are maybe coming up? A lot of these banks, regional banks, have lent a lot of commercial dollars out here in the last couple of years. And, are you working with people trying to extend it out? I mean, what's your plan if you see a property that, the rents are settling and not performing like you were hoping they were, and you might be taken back? I mean, what's kind of y'all's position on all that right now?
That's a really good question, and something that we all talk about, and I think Jody made a comment. When, first and foremost, regional banks are regional, and so we're in the markets, we live in the markets, we know the people in the markets, and if you have a borrower that is willing to work with you, you're going to work with them, hands down. I think that's just kind of a given point. I will say, we've all the banks, all the regional banks have forecast out upcoming maturities, played different scenarios on, okay, will some need to be right-sized? Like Jody mentioned, is that $10 million? No, that's $2 million. And it goes hand in hand. Would you like to move the rate all the way back up to a market rate? Well, what you like and what you're going to get and what's a good landing spot are sometimes two different things. But I would say this, being upfront, being communicative, providing the information is going to help you in the long run and on the front end. Don't let your bank second guess where you're at, and that'll play well for you, as far as the renewal and extensions. But the regional banks are going to want to work with you. That's just hands down.
Good, thanks for that. I just wanted to open it up really quick to see if anybody had any questions for any of the panelists. Does anybody have any questions?
I do. So, Brian, along with what Jody was saying, I've spent the last 9 months talking to over 30 regional banks. And every banker you talk to, you ask them, tell me about your trouble loan portfolio. And everyone says, well, we don't have any trouble loans. And so that's okay. Hypothetically, if you did, what are you going to do? So if you have trouble loans, other than, like you're saying, extend it out, what are the other alternatives?
Well, obviously, cash flow pays back loans. So repayment, be it IO, monthly amortization, if you're not getting any payments, and you're left with one choice really, and that's to take the property, but foreclose on it. But if the customer's willing to work, the banks are willing to work. We haven't seen problems across the region at all, and for most banks, it's I think Kenneth or Jody might have mentioned, underwriting since the last downturn has been a lot more stringent. There's more equity in it, and so that's given more flexibility for times like now. So everybody's been shocking rates to make sure on the front end that you leave room. So, but I will say loans that were underwritten when prime was or SOFR was in the threes, and then you're shocking at 200-300 basis points above that, you're still you're right there where you originally thought you'd be at. So it really goes back to the performance of the borrower, if they're willing to work with you. Bill?
Okay, for each panelist, if we're here a year from today, you're going to say 2024 proved to be what?
I'd say it's going to be the year we plowed through it. I'm not going to tell you it's going to look like this, but I'm going to tell you it's the year we plowed through it. And Brian, the only other thing that I'd add on to what you said was, banks can sell loans. I mean, our loan sales team has sold $2 billion portfolios in the last 90 days, one for Capital One and one for Truist. So a lot of them, both of them were comprised mostly of office assets. But so banks do have that option to do that on certain portfolios that make sense for them to do so.
And what would you think 26 is going to be? What would you say 24 was? No, and what do you think, and what are you looking forward to in 25? You think 25 will be a year that what?
I think I've heard all this crazy stuff like, survive 25, fix it in 26, heaven in 27, and I think all that's BS. So I really think we're going to get through 24, and then I think in 25 we're going to start going up. And again, I just want to make sure, because I said something earlier, if you look back at every 5-year period, going all the way back to the early 90s, real estate has never lost money over every 5-year period. And so, again, I think it is, and the biggest winners going back that time were like 2012, 13, and 14, because they were the first movers coming out of the GFC. And so, I mean, again, that's just how I see it. And yeah, the timing is, but I think by the time we get to the end of 24, we're not going to be going down anymore. It may be kind of flat, hopefully a little up. But my personal view is in 25, we're going to start to be moving up. I don't think it may look like that, but it's going to be positive. Transaction flow this year is down, I want to say it's almost 60% in our investment sale business. Selling properties is down. Obviously the debt business is down. The JV equity business is way down. But I do think as we come out of 24 and go into 25, we're going to start improving.
Kenneth, any thoughts on that?
I think 24 is the year that 24 is the year that stuff starts breaking. Okay, Wells Fargo was kind of one of the first to say, hey, we're out of the lending business, and that was kind of summer of 22. Okay, and so for 18 months, everybody's held on to what they had, found a way to get an extension from their bank. Investment sales transactions are down 60 or greater. And so, and that you can kick the can down the road for a while, but that's not a permanent long-term strategy. And so, I think 24 is where, if a conversation between borrower and lender, the lender's going to either force a sale or in transactions start to occur, and all of that I think is really healthy. Okay, because we don't want to be in the malaise for forever, and so I think 24 is a year where values reset, where transactions actually do start to occur. People probably don't like the transactions, or the pricing if you're forced to sell next year. But it's also, by the end of 24, we're on the other side of an election. That's behind us as well, and I think you start to build. I think the market starts to gain confidence. Whether it's debt or equity, nobody likes uncertainty, and I feel like that's where we've been uncertain on values. And I think in 24 you're going to finally start to see transactions occur at probably values that are ugly, but all of a sudden that is a building point for the market to start to have recovery.
I think you're going to see that in office. I'm not so sure. I think you're going to see that in retail, industrial, and multifamily.
What's your opinion on multi? I know Boyle's out there going. He knows more about multi than I've ever known. But it's you had a lot of. You talk about 2 caps. There weren't that many industrial 2 caps. There were a heck of a lot of multifamily 2s and 3
there were
caps.
definitely some industrial 2 caps.
But
maybe more in California. And stuff like
but
that,
multi like market was a 2.5 to 3.5, and so, and then if that rent growth didn't materialize, how do you see that? How do you see the multi-sector playing out next year?
I mean, I think the biggest thing is, and I'd welcome Brian's comments, but I think we got a housing shortage, and it may not be the returns that people wanted, and they may be less, but I don't think that market's going anywhere due south in the interim. Maybe some of the high-rise, really cool stuff down in Uptown, or something like that. But I think for the most part, I feel pretty good about multifamily just because we still have a housing issue, and we gotta fix that. Brian, you got any?
may be all right.
You know, I think the only thing I'd say too is on some of this, and we've seen it on a lot of the stuff we're doing now, is, and somebody made reference to it earlier, is I've always believed that land, maybe more so in commercial real estate, it's the plug figure. And costs can do whatever they want and everything else, but at the end of the day, when we're trying to get a deal developed, land is the plug figure. And I think we're going to see some of the land prices that we've been seeing come down. We've had a lot of land deals that have been dropped just because they can't make the numbers work. And at the end of the day, yeah, hopefully we get a little cost coming down, we get interest rates coming down, all that to help that return on cost. Because as I said, return on costs have definitely moved up on development deals. But I think you're going to see a little stuff going on with some land because I think it is the plug.
Good. Anything else? One more question.
All right, land, four-letter word, but it's the basis of everything. Are you seeing any softening whatsoever in the single-family housing market, brand new construction? I know most people here are involved in income producing property. That's the only sector that is performing well right now. Do you see any softening? We've got a tremendous amount of public home builders looking to move the majority of their construction off balance sheet, called land bank, for those of y'all who are involved with that. That's, so please, do you see any softening?
We have seen no softening to date at all, and I've been looking for it because people ask me that question all the time, and the lenders that I deal with want to know that. But the builders right now their appetite is as strong as it's been. You know, they let off the gas there for 6 months or so, but they're all back. They're looking long term. Like I said, they're looking 18, 36 months out, and they're paying the prices.
Interesting. Anybody else? Yes, sir.
From a risk standpoint, Ray Johnston had a steam panel. I kind of feel like a journalist after I came here asking a question to the press conference. How do you feel about your LTVs and also your risk for the tertiary markets on land acquisitions? Brian or Jody?
So you're saying, how do I feel about what kind of debt we could get on a land acquisition in a tertiary market?
Yeah, and also your confidence in a tertiary market raw land that'll eventually be developed.
I mean, I think for me, it would depend on how tertiary you're talking about, but we have a land deal right now that I'm working on up near the Dulles International Airport, and I'm just shocked, and I'm not gonna say who the lender is, but the rate is SOFR plus 8, and the debt's less than 50%, just don't even get me started. It's kind of frustrating. I think right now, I think land.
800 or SOFR plus 8?
800.
800.
800. And so you're talking about, you know, over 13% interest rate. And on this, we're having to get this one extended. And we got pay downs every year for 4 years, and that's the term of the loan. And I think land loans right now are going to be tough. I really do. I think land loans would be tough right now, even if you weren't in a tertiary market. And I think so. To me, I would say on land, if I was going to be buying some land, I probably would say I'm just going to buy it all equity for now.
Yeah, I would reiterate that. And the comment on Jody's 800 basis points, banks, we have.
And that's not a bank.
Yeah,
but
okay.
It's a debt fund.
But for us, a bank, we have to risk grade. And right now, if we all use different models, like Moody's model, whatever. But those risk grades determine how much reserve you have to put day one or allocation day one when you fund that loan. Raw land with no income is going to have one of the highest reserves outside of, office, spec office that's not owner occupied. So that has to factor in the cost of capital for banks and the cost of funds. So just know that every dollar loaned is not the same dollar to a bank. It is different. I agree with Jody. Land's going to be the more difficult thing to get done. Treasury, it's going to, for a bank, usually they're going to want to see a plan for that land, not just hey, I have this opportunity to buy it. You'll usually need something else along with that, as far as what are you going to do with it, what's it zoned for, things like that, and certainly at a low LTV, LTC on that. You're talking 50 or less, and I agree with Jody. We're seeing a lot more people going in and paying cash for the land side and getting it to where it needs to be before they come to us.
Well, good. Well, excuse me. Gentlemen, thank you for your time today. Really appreciate y'all coming up here and talking to everybody. All your opinions are very valuable, and thank you very much. Thank you. And I just want to close by just saying, if anyone's interested in one of these state manuals, just please let us know. We're happy to get one to you or your real estate attorney. And we appreciate everybody in here. Your business is very important to you, to us. And if you have any questions or there's anything we can help you with, please let us know. Thank you very much. Have great holidays.